On the morning of September 15th, 2008, employees of Lehman Brothers walked out of their headquarters carrying cardboard boxes. News crews lined 7th Avenue. Tourists stopped to photograph the tower's glowing ticker, still cycling the firm's name like nothing had happened. 158 years of history had ended over a single weekend. 25,000 people were suddenly looking for work, and the global financial system was hours away from freezing solid. But the collapse everyone watched that Monday had been written into the firm's own balance sheet for years. The warnings were there. The regulators saw them. The system just had no way to act on them. Lehman Brothers started in 1850, 3 immigrant brothers trading cotton in Montgomery, Alabama. It survived the Civil War. It survived the Great Depression. It survived 2 world wars and a dozen panics. By the 2000s, it had become one of Wall Street's great investment banks. And that word, investment bank, is the key to everything that follows. Lehman did not take deposits from ordinary people. It borrowed enormous sums in the short-term markets, much of it overnight, renewed every single morning, and used that borrowed money to fund long-term bets on mortgages and real estate. That model works beautifully as long as 2 things stay true. The assets hold their value, and the lenders keep lending. In 2008, both stopped being true at once. Through the housing boom, Lehman loaded its balance sheet with mortgage risk, and it did it with borrowed money. By 2007, the firm was leveraged roughly 30 to 1. For every dollar of its own capital, it had borrowed 30 more. At that ratio, a drop of just 3 or 4% in the value of its assets was enough to wipe the firm out entirely. And its assets were exactly the thing losing value fastest as the bubble burst: mortgages and the houses behind them. Foreclosure signs were going up on lawns across the country. Every one of them was a small subtraction from Lehman's side of the ledger. Wall Street got its dress rehearsal in March 2008. Bear Stearns, a smaller investment bank with the same funding model, collapsed in a week when its lenders lost faith. The Federal Reserve caught it on the way down, financing a rescue sale to J.P. Morgan. And then the Fed did something it had never done. It opened its emergency lending window to investment banks and began watching them from the inside, on site, every day. The examiner's files show Lehman drawing on that emergency facility again and again that spring. Inside the Federal Reserve, staff began drafting plans with unsettling titles: a game plan for a potential Lehman failure, options in the event of a run. One email to Chairman Bernanke that July put it plainly: there are no good options. Here is the part that turns a bad bet into a postmortem. Lehman knew how its leverage looked to the outside world, so it hid it. Through an accounting maneuver called Repo 105, the firm temporarily moved roughly $50 billion of debt off its books at the end of each quarter, just long enough for the public reports, then brought it back days later. Quarter after quarter, the published balance sheet was a photograph taken at the one moment the room was clean. As late as September 10th, 5 days before the end, Lehman executives were on an earnings call assuring investors the firm's liquidity remained strong. The picture regulators and investors saw was not the real one. The bankruptcy examiner would later fill volumes documenting exactly how the trick worked. None of it was visible from outside, and everything depended on no one looking too hard. When the market finally doubted Lehman, the doubt fed itself. Lenders who funded the firm overnight simply declined to renew. Trading partners demanded more collateral. The firm's own clearing bank grew afraid of being the last one holding Lehman's risk when the music stopped. Each demand drained cash the firm did not have, which deepened the doubt, which drained more cash. By the second week of September, the Fed's own staff described the situation as spinning out of control. Hedge funds were pulling their accounts. Nearly every large fund had called to say others were refusing to take Lehman's name. This is a bank run, not with a line of people at a teller window, but with institutions clicking no on a screen. It can empty a firm in days. It emptied Lehman in 4. Over the final weekend, the Federal Reserve and Treasury summoned Wall Street's chief executives to the Fed's fortress on Liberty Street to find a buyer before Asia opened on Monday. There were 2. Bank of America looked at Lehman's books, walked away, and bought Merrill Lynch instead, rescuing the next domino in line. Barclays wanted the deal, but British regulators refused to bless it in time. And this time, unlike Bear Stearns 6 months earlier, the American government chose not to put public money behind a rescue. The line had to be drawn somewhere, and it was drawn at Lehman. At 1:45 in the morning on Monday, September 15th, Lehman Brothers filed the largest bankruptcy in American history. $639 billion in assets, 6 times the size of any American bankruptcy before it. The people who let Lehman fail believed the market had seen it coming and priced it in. They were wrong. Within a day, a giant money market fund that held Lehman paper broke the buck, something savers had been told was impossible, and the panic jumped from Wall Street to Main Street. Credit froze. The government that had drawn the line at Lehman spent the rest of the month erasing it, rescuing the insurance giant AIG, guaranteeing money market funds, and asking Congress for $700 billion to prop up the entire banking system. Letting one firm fail did not stop the bailouts. It made the rest of them inevitable. The lesson of Lehman is not that one firm was reckless, though it was. It is that every warning sign, the leverage, the overnight funding, the hidden debt, was sitting in the firm's own numbers, and some of it in the regulator's own files, months before the end. The system had no mechanism to force those numbers into daylight until the collapse did it for them. The official inquiry reached a verdict history rarely offers so cleanly. This crisis was avoidable. The postmortem writes itself. The only question is whether anyone reads it before the next one.